And we actually have quite a lot to cover tonight, so there's a good reason for kicking off on time. Those of you who I haven't had the opportunity to meet, and hopefully someday I will get to meet all of you in person. My name is Jeff Stangl, and I chair the CFA Society of New Zealand, and I am also at Massey University. And this is the 13th, if you can believe it, the 13th one of these annual ethics workshops that we have done over the years since 2009. So you think I would have become fairly competent at it by now, but we will leave that with you to decide, because doing an ethics workshop, I have to say in all candor that the subject of ethics isn't necessarily the most exciting one, even in person. And it's even more difficult when you're doing it virtually, online, on Zoom. Even though we've all become accustomed to Zoom, it still makes it a bit challenging because it doesn't really provide for good interaction. So we'll give it a go. We did it last year. This is the second year we've done it online. And the reason we're plowing through and doing this even in a virtual format is because of the importance on the topic. Now, actually, I'm jumping ahead of myself because there was one thing I did want to say before we kick off and jump into the ethics, and it kind of all ties to ethics, and that is to acknowledge the stress that those of you, presumably you're all candidates in some form or fashion, level 1, level 2, or level 3. And I just want to acknowledge that I'm sure it's been very difficult, the uncertainty of the exams being canceled, the move to online. This is a remarkable time that we lived through. So I'm sure to some degree, it's kind of what we have to deal with. But nonetheless, it doesn't take away from the fact that it is very difficult to be preparing for what is a strenuous exam, and that you don't really know with certainty when exactly it will be held. So I do want to acknowledge that, and I do want to acknowledge that CFA Society New Zealand, particularly Kylie, who's stepped in the background there, is very, very responsive to any sort of needs you might have, and certainly as a society we'll do what we can to support you as candidates. Okay, so that's just a bit of a prelogue. Ethics. You may or may not have an awareness of the importance that the CFA program curriculum places on ethics. It's 15%, 15% of the total curriculum. So it's equally weighted with the other topics: quantitative methods, macroeconomics, portfolio analysis, economics, etc. And it is important. And in fact, if you don't get the ethics right, you'll struggle to pass the exams. And I will say this to you, that while it maybe seems as the easiest topic out of all the different curriculum topics within CFA, personally, and I think the evidence shows that most will find the ethics segment very, very challenging. And I did myself, to be perfectly candid. The ethics, out of all the topics, and I believe when I did it back in the day, there were 7 curriculum areas, ethics being one of them. I performed the worst on the ethics section than I did on any other one. Still passed the ethics, but it was my lowest mark. And it's not to say that I'm unethical or my orientation is unethical, but to me, what makes ethics really, really challenging, my brain is wired kind of binomially. It's either black or it's white. And what you will come to find out, if you don't already have an appreciation for it, is that ethical considerations are indeed generally found in a gray area. They're not black, they're not white, they're kind of in between. Of course, there's clear exceptions to that, but certainly when it comes to the CFA questions on your exams, they are very, very good at making, the problem sets as gray as possible. So to me, when I teach ethics and the CFA Code of Conduct and Professional Standards, my mission tonight is really going to be not rote memorization, but my mission will be to kind of help raise an awareness of why ethical considerations are important to you in your professional career, and why it's incredibly important to the industry that you are in or will join, and to break it down into basically the CFA standards, professional standards are 7, but there's really only 6. The last one relates to the CFA branding and what you can claim or can't claim as a CFA charter holder or as a candidate. Okay, so really there's just 6 to my view when you go certainly into your careers. So what I want to do is help to develop an intuition that will help you in studying in depth, preparing for the ethics components of your exam. So initially, let's see if I can get, there we go. Initially, what I want to do is just kind of set the stage, and we'll just talk a bit about, why it is that the financial markets, why it is that the investor population is demanding higher standards for professionals who will join and become a CFA charter holder. Now, to start with, if you look at this particular first slide, basically it's saying that the investment market, firms and investors, they are demanding higher standards. And there's a reason for that. They're demanding professionals who look after their interests. There are demanding professionals who act objectively, who are clear in their communications, are not misrepresenting their findings, who act objectively without any prejudice in the client's best interest. That's what professionals do. And you'll probably find it somewhat, I don't know, perplexing, I suppose, to me, because, when you think of professionals, financial advisors, for example, are not what comes to mind. Typically, what comes to mind is professionals, lawyers, accountants, for God knows, I don't know why accountants per se, but that's a profession. Doctors, that's a profession. Financial analysts, people who deal with billions of dollars, aren't, by general Joe Blogg investor, the public at large at RIT, are not considered professionals. And there's different reasons for that. If you think of a doctor, a lawyer, they have, annual continuing professional development requirements. Similarly with accountants, they have ongoing continual learning. The investment profession at present generally does not require ongoing CPD. In New Zealand, we do now, and different regulatory agencies across the globe are starting to, but that's new. That hasn't really been the case previous to the most recent sort of scandal. And, we had one across the ditch over in Oz a couple of years back now that resulted in a commission that started out with the AMP, bit of a scandal there. You can go through any list in the United States with Wells Fargo, with you name the different financial entity in the US. And there is no shortage of examples of a lot of dodgy business going on, which isn't to say that the industry as a whole is dodgy and is unethical, but certainly there are very high profile cases that get the public's attention. And the reason that is so important, besides the obvious reason of making sure that we as professionals in the sector uphold the highest underpinning of ethical behavior and also professional competency, is it's important for everybody, because if you think about it, if the investment investors are uncomfortable with turning over their hard-earned cash to you as their investment advisor, their financial advisor, what do? The money's not put to effective use. It's not optimized. Back in the old days, many, a decade or so ago, when there was all the runs on banks back in the day, or the 1930s, not even 20s, I should say, not even a century ago, people were putting money in pillowcases under their beds or burying it in their backyard because they had no confidence in the financial sector. So the CFA Institute's mission statement to lead the investment profession globally by setting the highest standards of ethics, education, and professional excellence for the benefit of society, which is also the CFA Society New Zealand's mission statement as well, similar to that. And the last phrase there, I think what I'd like you to do is lodge that particular phrase in your mind when you go through, and to me, when you go through these different questions and standards, you're looking at, why do we really care about this? Well, because we're wanting to protect, the investment population and ultimately benefit all of society through enhanced confidence in the sector. Because when the sector investors are confident that you are looking after their best interests, you're looking after your best interests in an objective, transparent way, then they will, release their hard-earned money to your care, and that's going to get put to good use. And suddenly that's the grease in the wheels, global commerce, that kind of gets things moving. Okay, so that's why we really care about this. Vika, I'm probably, because was one of my dear colleagues from Mass University, and she's right on my screen, front and center. So Vika and everyone else is blanked out. So I'm probably going to be asking you lots of questions as we go through the to try to get some interaction. Now, this particular equation, to me, and again, I'm setting the stage here, so bear with me. I think a lot of you will come to this session just hoping to get answers and going over the standards. But, again, to provide the background, this is a CFA Trust Equation, which says that credibility plus professionalism equates to trust and value. Okay, so credibility, that's your code of conduct, your ethics. Professionalism is your competency. I've already mentioned that. And that equates to the trust that you have as an investor in your professional advisor and to your CFA charter holder. So that all kind of makes sense, but I want you to focus on one thing. And down at the lower right-hand corner, what you'll see is a statistic that you probably would skirt right past that. So 35% of retail investors, mom and pop investors, believe that their advisors or asset managers put their interests first. I'm paraphrasing. That's what this study finds, 35%. Now that's quite remarkable. This is in a recent study, well, not that recent at this point. This, I believe, came out of a 2017 report, so it's already 4 years old. But 35%, what that says is that 65% of retail investors do not believe that their advisors put their interests first. That's quite startling. Okay, so these are retail investors who don't know the industry inside and out. But to me, what's even more disturbing is if you look to the other figure there, 25% of institutional investors. These are people who work for KiwiSaver funds as managers, who work for big wealth management organizations. An even smaller percent of those professional institutional fund managers, investors, fund managers, they believe that asset managers put their interests first. The nuance of this point is that the people who know the industry, an even smaller percentage of them believe that their interests are put first. That their investment or asset manager, their advisors, are acting in their best interest in an objective and transparent sort of way. I don't know about you guys, but to me, that seems pretty startling, actually. I don't know. It's kind of hard to be speaking to a group like this online because I can't really get a sense of whether or not this is really sinking in. But I don't know. Personally, I find that quite startling. Okay, so as we go through these standards, you're looking at the core values. What is it we're looking for? We're looking for ethics. We're looking for a culture, a culture of ethical behavior. To the financial markets of credit, and they deserve a lot of credit for really turning the New Zealand financial markets around. What the Financial Markets Authority of New Zealand, very much with their code of conduct, what they are very much focused on is establishing a corporate culture, a culture that starts at the very top of any organization and kind of cascades through the whole entity, a culture that that's directed by good governance, that a culture that upholds the highest standards of ethical behavior, honesty, looking after their customers first, etc. Integrity comes to mind. All of these sort of values, which are the underpinning values when we talk about ethical competency and ultimately professional standards. Okay.
Jeff, is it all right to ask questions?
Absolutely, Robert, go for it.
Sure. So it just on that, are there any other nations that are sort of shining lights in that area, or are we even shining lights?
The other other countries are some. Australia is a few years ahead of us. Their regulators. Europe is. Asia, Southeast Asia, I think predominantly Japan certainly is. Certain countries within the EU, definitely. UK, definitely. The US is really probably not surprisingly a bit of a laggard in terms of sort of prescribing or really pushing to have a good sort of solid code of conduct. The US regulatory environment tends to be more prescriptive. And what the New Zealand regulator is doing is they're really wanting to imbue a culture. And why is that important? I'll talk a bit about that. That's important because if you prescribe all potential acts of all behaviors, you're going to miss out. There's going to be, the devil's in the detail. Like the US, for example, the US GAAP accounting codes is very, very prescriptive. But to get around the rules and regulations, all you have to do is hire a good lawyer and a good accountant, right? So it makes a lot more sense. If you look at the newly, revised Financial Market Authority, their code of conduct that came out in March of this year, it's very much about setting the tone and not prescribing the outcomes, which I think is very commendable. So that's what you need, and we'll talk about that, Robert, a bit on it. I think it's really a good question. But so these points we're looking at here, and they're hierarchical. First of all, first and foremost, client interests always come first, full stop. Now, that gets complicated because it's not, believe it or not, it's not always easier, as we'll see later, to ascertain, who the ultimate client is. So, as an example, if you're managing a pension fund, who is the for you could be a manager for sub-manager for a pension fund for KiwiSaver. Who is your client? Is it, you might say ANZ has their KiwiSaver funds, that they would, have other asset managers managing segments of that. So those sub-managers, who is their ultimate client? Is it ANZ? Or is it the actual ultimate beneficiary of the KiwiSaver account, the account holder? Well, it's the account holder. So it's not always that easy. You have to think into actually who owns the asset. That's the key thing. In all instances, maintain independence and objectivity. I've already spoken about that. You don't want to be conflicted. You need to be able to make a decision based on the facts. You don't want to go into an investment decision owing any particular allegiance, to whomever, to a corporate for pushing their or to different outside entities. Okay, you need to avoid and declare any conflicts of interest. Full and fair disclosure. Where that's really, really important is, you don't want to be perceived as concealing information. You need to have full disclosure to your clients. Give them all the information that they need to evaluate your recommendations. And it needs to be presented in such a way that they can actually access the information. Because kind of one of the old standards was you could obfuscate, you could disclose, but you could disclose in such a way that nobody but a lawyer would understand it. Okay, so full and fair disclosure in an accessible form, something that your particular client market would understand. Preservation of confidentiality, that goes without saying. Fair dealing. Fair dealing gets complicated. We'll see some examples later. So fair dealing implies that you treat everybody you provide information to everybody with impartiality, that you don't show preference to any particular group that you might represent. Where that gets complicated is, and we'll see the example, is what if you have a gold standard client who pays for a premium subscription, and just pick a number, is paying you $100 a month for the service of the gold standard, that they expect. And you might have a bronze standard client that pays you $25 a month. So in that case, well, one could argue that doesn't, your gold standard client actually deserves better treatment. So that's fair. They're paying more money. Why not? That is a violation of the standard. The standard says that you need to provide equal access to information. So if you, for example, if you have an IPO that comes out and, IPOs generally are hot tickets, they're oversubscribed in most every case. You need to give all of your clients access to that IPO. So you can push that out, for example, via email, and then you get on the phone immediately after that and you call your gold standard customers and have a chat with them. That's okay, because that's this type of service that they pay for. But you can't call them first and then make that the information pertaining to the IPO available to your lower class clients later on. It's got to be everyone equally at the same time, access, and then you can call around to your different classes of clients. Okay, reasonable care. Reasonable care and prudent judgment. That's another very interesting concept. The prudent judgment comes, and that word is actually very important, prudent judgment. So this to give you a bit of history, and this comes, the CFA program is US based, I think, as you'd all be aware. And the prudent man rule is very much a well-established fact of precedent established in US law. And it was a very famous case by Harvard, the Harvard Endowment Fund, against their asset manager back during the stock market crash in 1927. Basically, Harvard took their asset manager to court because they lost considerable amounts of money with the crash, the 27 crash. So they took their asset manager, Harvard took the asset manager to court and said, hey, we want to, claim back all the money you lost because, you made a bad call. And what the judge, and it ultimately went to the Supreme Court, what the Supreme Court ruled in the US was how they looked at it as such. Given the situation at the time the decision was made, So in this case, prior to the 27 crash, given all the information that was available at that particular point in time, a concurrent point in time, was the investment decision prudent? And in that particular case, the Supreme Court ruled that it was a prudent decision that the asset manager made at that point in time, at that instance in time. So therefore, the losses incurred by Harvard in this case, after the crash, nobody has a crystal ball. So that was thrown out as irrelevant. And in fact, the prudent man ruling is very much a basis in law and precedent that most would subscribe to. I think all jurisdictions at this point, not knowing all jurisdictions, but I'm assuming that would be the standard. Okay, so that's that. Okay, so just to go back to that, and I'll make these slides available to you. So this is these different points, or 7 in this case. This is the basic guiding principles for the standards, the six certainly of the 7 standards that we'll go through with the CFA professional standards. Okay. Any more questions? I love questions, Robert. So Robert or Vika or anybody else, it gives me a chance to take a breath, to stop. Vika, you can ask a question. That's okay. Now I've just caught her out. She's not there. I think she is. She's moving the button. Okay, cool. Okay, so this is just a little bit I threw up here, and I think this is important to bear in mind as you move into your profession. Situational versus disposition. Dispositional is how you're disposed to do something. I mean, I would like to think of myself as dispositionally being inclined to have the highest ethical standards. But we all get in situational environments where our character is challenged, can we say? I mean, I think you can all relate to that, right? And then what happens? Then what happens is, well, I can rationalize it. It's like, well, this is what everybody else is doing. My mate who works down the hallway, he's doing it. If Vika's doing it, it must be okay if I do it. And that's where that culture comes in. If you're looking situationally at those around you, your environment, and everyone acts poorly and is not ethically grounded, their ethical compass is askew, then suddenly that seems to be the norm, and then it becomes a slippery slope. And that would be the other thing I would say to you as kind of, I think, a life's guiding principle is to make sure that your ethical compass is always pointing to the true north in all situations. And there will be situations where you think, oh, this doesn't really matter, it's just a couple $100, nobody's really going to notice. But you start becoming sort of immune to, your compass starts going a couple degrees off north, and suddenly things get, yeah, that's okay, we can do it. I mean, I had an example. In fact, it was last year during lockdown, our first lockdown, one of the many. I went up to the local Foursquare, and anyway, in Auckland, we've got the little rubbish tags. I bought the rubbish tags, and I always buy like a quarter's worth, 3 months worth at a time. And, this gal gave me, instead of giving me the safe, for example, instead of giving me 20, by mistake, she gave me 30. And I went home and I counted them. I was like, oh, geez, I got 30, and they're $5 each, so that's an extra $50. So I marched back to the Foursquare to return them. They didn't want to take them back. I had to argue with them to take it back because for whatever reason, because they had to run it through their till, and this was just the clerk. And I was thinking, God, did I do the right thing here? I mean, I could have just kept the $50 extra and not worried about it and saved the hassle. But in actual fact, I felt good about it afterwards because it did take effort. I did have to go back and walk an extra couple kilometers back to the Foursquare. But, you know, I felt at the end of that, yeah, my compass is still pretty much pointing true north, and that felt good. So if you have that sort of confidence, I think that's a good thing. Because under the right conditions, even good people can be seduced to act unethically. And I would challenge you to all think yourselves, and every one of you would have a story to tell on situations where either you or colleagues, friends of yours, have not acted in an ethical way. And I would argue to you that if you set your compass, fix it to true north in all situations, not just those pertaining to your careers, I think it'll make the decision-making process a lot easier. You know, I mentioned, I alluded to the rationalization. Rationalization is a funny thing, I've got to say, because we can all justify bad behavior. It's quite easy. It's quite natural, to be honest. And, you know, unethical behavior, we can rationalize, you know, for example, plagiarizing. We'll talk about that a bit later as well. Oh, well, the book companies, you know, CFA charges too much anyway, so, and they don't need the money, and you know, it's just me, and that doesn't count. You know, we had it was actually quite, to me, disheartening a couple of years ago, probably 2018, I suspect it was. We worked quite closly with Kaplan Schweitzer to provide kind of the training materials, and we had some training courses for CFA for you for level 1 exam preparation. And we had a number of students sign up. And, you know, we got a really good deal from Kaplan Schweitzer. And this say if they normally sold the books for $300, I can't remember exactly. And we got them to give it to us for $100, you know, so a third of what they normally charge. And would you believe, and this was for a CFA candidate group, that we could not get one single individual who wanted to pay Kaplan $100 for their material. And why was that? Well, because, as they told me, the students, well, you can get them all online. They're all pirated. You can download them for free. Why? I don't want to pay 10 cents, let alone $100. That's unethical. And I was actually inclined to cancel the course. Because in particularly, you know, Kaplan, Schweitzer, they were already doing an incredible service by providing this. And I told them, I called them up. I said, look, I've got a situation here. Our CFA candidates are acting a bit unethically. Everybody else does it, they tell me, that nobody pays for textbooks. So therefore, they're not going to pay anything, and I'm going to cancel the course. And Kaplan said, to their credit, I don't understand why. I certainly wouldn't have. They said, hey, look, you know, don't worry about it. You can still go ahead and use all the online PowerPoints and videos and everything else. We won't sell you any books at all. Let them find them wherever they want, which I thought was incredibly magnanimous. I couldn't believe it. But anyway, that's a bit of a story. I tell a lot of stories, as Vika will tell you. But I think, you know, this rationalization process is something that you need to be aware of. Okay, so we're basically 30 minutes into this, and we're just now going to come to the Code of Conduct and Professional Standards. But what I've done up to this point in the first 30 minutes is, I hope, is to raise your awareness of why ethical behavior is important, why professional competencies are important, why independence, objectivity is important, while recognizing the needs of your clients first is important. It goes back to the CFA mission. Ultimately, that lost line that I told you about is why we're all doing this. Ultimately, it's in all of our best interests, because the reason we're wanting to raise the bar of the industry, raising professional standards, etc., is because it serves the betterment of society writ large. So that's why it's important. If you want to look at it quite, I suppose, selfishly, why do you care about it? You should care about it because when you go out into your careers, and those of you who are already in your careers and this coming late in the game to the CFA qualification, you have a personal brand. And if your personal brand gets tarnished by the brush of unethical behavior, you're going to have a hard time keeping clients or getting clients. You're going to have a hard time progressing your career. In fact, you might be kicked out of the profession altogether. So from a very selfish point of view, forget the benefit of society for your personal benefit. And I'll tell you, there's research, and this again is to the 2017 research that the CFA did, basically looking at kind of the mega trends around the globe in terms of financial services sector. And most of you should be aware of the fintech challenges, automated kind of advisory, software, et cetera, that have placed a lot of financial advisors out of work. Well, what the research shows is that, in actual fact, that there is a very much a strong market for financial advisors, financial analysts who have a strong personal brand that is associated with the highest ethical underpinnings and professional standards, because people still don't trust computers to do everything, and they want to put a face to it, and the face they associate with is one that has highest ethical standards and professional competencies. Your business will be good, fintech or otherwise. Business is good. So that's raising the bar in industry. Okay, phew, we got there. Now we're up to those of you who are looking to this kind of get a sense. And normally I would spend a couple of hours on this, so we're going to go through it pretty quick. I might check back in with Kylie. I'm always happy to do some additional workshops. This doesn't have to be the only one. So if we'll get through this quickly tonight, we have an hour left. We'll kind of blast through these and it'll come pretty fast. The reason I'm limiting tonight to an hour and a half is simply because I think that's stretching it. You're going to start to fade out here within the next hour, and it's kind of doesn't serve a purpose. I'm happy to come back and kind of spend some time on these standards more in depth at a different point if there's enough demand for it. Okay, so Code of Ethics and Standards of Professional Conduct. We have the Code of Ethics that we'll speak about. But if you look at these 7 standards, professionalism, the integrity of capital markets, and ask yourself what that means. What does it mean when we talk, well, professionally, you probably have a clue. Integrity of capital markets. I mean, capital markets, the stock exchange, the bond markets, different financial asset markets, whatever they may be. Real estate, real estate's got a bad rep as well. It can be precious metals, commodities, alternative investments of any form or fashion, venture capital, all these kind of things. If there's a question about the integrity of any of those markets I just enumerated, people are not going to invest in them. So it's very important for us to maintain the integrity. Duty to clients, and you'll notice kind of the ranking here is not accidental. Duty to clients, duty to employers. You do have a duty to your employer, but your duty to clients comes first. Your investment analysis, that's obviously critical. Your recommendations, the actions that follow out of your analysis. Are you making a prudent decision based on the facts at hand? Are you objective? Are you clear in your communications? Can your client be able to ascertain through your analysis and recommendations, what you're actually recommending, what you're describing? Conflicts of interest, that's a big one. And the last one I keep alluding to, responsibilities as a CFA Institute member candidate. That's kind of a lesser of the standards. Okay, so what do we have here? So the Code of Ethics, which kind of embodies all of the professional standards. You act with integrity, you act with competence, diligence, respect, and an ethical manner that protects the public clients, your prospective clients, your employees, the whole market. So we talked about, protecting the market writ large in society. These are all stakeholders. Clients are stakeholders, prospective clients are stakeholders, employers are stakeholders, your employees that work for you, colleagues that work with you, the investment profession at large, and capital markets. These are all stakeholders. Okay, so you're looking to maintain a certain standard across all of those different stakeholders, and that's what the 7 professional standards really point to, that get into the granularity of that. Code of Ethics says that you must place the integrity of capital markets of the investment professional above all else, and the interest of clients above personal interests. And that gets really mucky. Can I say that gets really, really mucky? One of the things, as I've said already, so the CFA exams, ethics constitute 15% of all the curriculum. And as I've already also said, I certainly don't find it easy. And I think a lot of people are dismissive of it. You need to focus, and you really need to develop the intuition. Okay, use reasonable care and exercise independent professional judgment when undertaking investment analysis. That then goes down to making a recommendation. So when you're appraising alternatives, you need to do it with an objective lens. You can't come into the process of kind of ascertaining the value of investment A, B, or C if you have a prejudice towards one or the other that might be due to a conflict of interest, right? So if you're getting paid by, if you're an asset manager and you can choose between, some different asset classes, and who's ever selling you a particular, asset, they're paying for you to take a trip to the Bahamas to do your own research while lying on the beach in the Bahamas back in the days we could travel. That's going to cloud your judgment. I think that's fair to say. So we need to be aware of this when we make recommendations and take ultimately investment actions. Robert, questions? You'll be sorry, Robert, that you asked me that one question, I reckon. Okay, that's okay. You're still on mute. That's okay. Who else can I pick on? There's lots of people here. I don't know. Vika, are you still there, Vika? Oh, look at it. There's actually people over here. The screen I was looking at, it was just all names. Oh my God, there's like real people. Hilka, do I pronounce that right? Hilka. This is exciting. There's actually real people here. This has just made my day. I was looking at a screen that was just names and no images. So I'm excited. This is great. Okay. You can tell me I'm getting giddy now. Anyway, so professionalism. Okay, so all of these different, this is standard 1, this is professionalism. So even though there's only 7 standards, within each of the standards, there's a variety of different subcategories, sub-areas of knowledge. Knowledge of the law, independence and objectivity, misrepresentation and misconduct. The first one we'll talk about is knowledge of the law. And as you might imagine, ignorance, there's 2 key points here, and there's a lot of text here, and I typically don't like to do PowerPoints with a lot of text. Okay. Ignorance of the law is not an excuse. Number 1. Okay, the professional expectation is that you will maintain your knowledge of the law and keep it current. That as, for example, like with recent changes to the Code of Conduct, New Zealand, it's expected that you are up to speed with that and that you keep up to speed regularly. This to say, I didn't know they had a new change to the Code of Conduct in March of 2021. Geez, sorry about that. That's if you were to take away 1 point from this particular section, that's the knowledge of the law. You need to maintain your awareness of laws as they change. And it's also not good enough, for example, if you're offering advice to a client in a different jurisdiction, it's also not good enough to say, yeah, no, my client lives in Sydney and, I'm offering advice and selling them a product out of Australia. I didn't realize. Is that a law? Really? I'm not allowed to do that. Oh, that's funny. So you need to have an awareness of the law across jurisdictions if it applies. But here's the other thing that seems maybe self-evident, but this will be a big feature of certainly the CFA exam, and that's understanding that there are different levels of strictness, and there are some countries where, for example, insider trading is still legal, that you can trade on inside information. Matter of fact, in New Zealand, it was legal up till maybe at this point, maybe probably 2006, something like that, where you could trade on inside information, and there wasn't really a wide enforcement of insider trading. But at that point in time, matter of fact, and I'll come to this in a sec, if you were a CFA charter holder, and while it was kind of okay to trade on inside information up to 2006 with a Financial Markets Conduct Authority legislation, as a charter holder, you would have been in violation, and you would have had your charter rescinded. Because even though it was okay in New Zealand, it was not okay per the CFA Code of Conduct and Professional Standards. Okay. And it was quite interesting. I'm sure I'll make this story quick, because more or less shortly thereafter, probably that time, I was at a workshop. It was at the Vero building. I think it was at Forsyth Bar, although they weren't there. Anyway, it was one of those places. And it was a big group of professionals, and the topic was insider trading. And basically, the view was at that point in time, and they were primarily CFA charter holders, it's only insider trading if you get caught. That there were all kinds of reasons that you could justify something as, well, it kind of is public information. So that's not really. I was quite flabbergasted, because I was a brand new minted CFA. And I was like, whoa, this isn't what I learned. No, I think you guys are wrong here. Anyway, I found it insightful. That all's changed. Okay, so knowledge of the law also says that if you're aware of any people's violating the law, that you need to disassociate. Where this gets complicated is if, for example, a client, let's use an example of a client. If you have a client that you think is participating in dodgy practice and is generating money illegally, you're not really sure, but you have a suspicion, okay? So this standard says that, well, you need to disassociate, or you need to, if it's illegal activity, you actually need to bring it to the attention of either your superior or the appropriate authority. Then the question is, well, another standard further down, I think it's standard 6, I believe, confidentiality. Standard 6 confidentiality says that you have to keep any information pertaining to your client, private, in confidence. So there's kind of a disconnect between this standard, standard 1, and the standard pertaining to confidentiality. So when is it okay to violate confidentiality out of recognition of standard 1, which is violation of the law? And those are the type of questions that the CFA is really good at. And to give an example, and this was a discussion back in the day when we were traveling, it was myself, it was the CFA senior leadership group. We were meeting someplace, and as one does, we have ethics workshops. And one of the questions was, I'll try to make this as short as possible. Basically, you had a pensioner, had a bunch of savings, you were managing her account. You'd noticed that she had written a large check to somebody that you weren't really familiar with, and it struck you as being unusual. In fact, the pensioner a month later wrote a second check for an equally large amount. So you suspect that whoever is getting her to write a check is, dodgy and taking her for her money. But then you also have the commitment to not turn her in due to confidentiality clauses. So what do? And this is a good example of kind of a gray area because, and we sat as one does, we debated that within this group, and we never really came to any clear conclusion. Ultimately, I guess we did, the majority felt that violating confidentiality was okay because this had happened more than one time and there was a pattern that was established. And because there was a pattern established, and the first time was kind of a red flag, the second time was the establishment of a pattern. So therefore, it warranted disclosing certain information and violating confidentiality. These are the type of questions you'll get on the CFA. And I suggest to you on the exam, I suggest to you that you go through all of these questions. The one thing is, I will say, probably more than the other curriculum areas with the ethics, is you can go back, you can look online, and there's all kinds of resource available for going through a lot of different questions for these standards. It really pays to go through and spend the time to do that, because the scenarios, while they maybe change slightly, the names change, the firm changes, they all sort of repeat these sort of similar, unusual sort of circumstances like the one I just described. Do you know what I'm saying? Like that case with a pensioner. So if you go through those examples, I think you will get a good familiarity of the types of quirky questions that they would ask. Okay.
On that pensioner scenario, would you not, before you sort of disclosed it to authorities, would you not have a chat to your client first?
Yeah, in that case, that would be the appropriate, Robert. That would be appropriate. I can't remember that in that particular example I gave you, had that been done or had that not been done. But you're absolutely right. In that case, that would be the appropriate, I think, first step. And then if your client was still in denial, but you still had suspicions, and then maybe that was the case with the example I gave, then you progress it up the food chain, kind of a thing. I think now that my memories trigger those couple years, I think that was the case. Because you see it all the time, actually. I mean, I think there was an article in the news last week where some lady was bilked for basically most of her retirement money here in New Zealand. And she was still, the bank had told her not to send the money. Did you see that? I think it was about maybe 2 weeks ago now. The bank had actually said, and they called her up and said, no, this is a scam. This is like the classic widow, found new love, give me your $100,000. And the bank actually called and told her not to do it, advised against it, and she still insisted, and she did it, and then came to find out later that day or after the money was sent that in fact it was a scam, and she called the bank up complaining, and they're like, money's gone. Sorry, can't do anything about it. But yeah, people get really locked into that. Okay, so procedures for standard one, staying informed, review procedures within your firm, your own organization, for keeping up to date, for how you deal with some of these dodgy, if you sense that something untoward is happening. Yeah, disassociate, legal counsel, these are all self-evident, I think. Staying informed being the top one. So firms at that governance, that cultural aspect, have a code of ethics, similar to FMA. Disseminate, updates to code and practice, and have typically certainly any firm of any size at all right now, compliance has become a huge cost. And I see one gentleman looks like he's senior in this group. Another Robert. Compliance has actually become rather expensive, but typically there are compliance officers within an organization that kind of have overview to make sure that that there are procedures in place, that there's reporting lines in place, and all that kind of stuff. Independence and objectivity. Okay, and this also relates to conflict of interest that we'll talk about later. So independence and objectivity, I think that should be self-evident. I certainly have spoken enough about it already. You need to maintain your independence to maintain your objectivity in making investment decisions. Because, you know, our views can become jaded by any number of things. And more than anything, money tends to jade our objectivity. You know, so for example, you might be working with a broker that is giving you something called soft dollars. So they might be charging your client more money for transactions and trades, but they provide you, you know, the investment manager with what's called soft dollars. It's like, oh, Jeff, didn't you need to go to Jamaica and do a bit of market research, you know, on offshore, you know, funds or whatever? We'll pay for your ticket to go over there. Oh, by the way, we're charging more for trades and transactions than our competitor, but that's okay. You're going to get this money as soft dollars, and your client will never know the difference, right? So that type of practice actually happens pretty regularly. So that's how you maintain your objectivity, is you're aware of all these little bits and bobs. Accepting of gifts. You know, and again, this gets very complicated, because if you look at what is a gift? You know, is it something over $1,000? Is it something over $100? What defines a gift? What clouds your objectivity? Most organizations, I'm at Massey University, we have a very strict gift policy. Anything over $50, $50 and above, I've got to put in the journal. I've got to turn it over. I've got to declare every aspect of where the gift came from. It's just too much bother. We don't do it. And if someone says, "Oh, Jeff, I'd like to give you, you know, a little token," it happened just a couple of weeks ago to me, and I was like, no. You know, your support is all I need. I don't really want that, if for no other reason, because it's really a bother. I've got to go through this whole reporting process. I have colleagues at ANZ, and also, matter of fact, I had the CEO for BNZ, and he did something for us, and you know, I offered to give him, you know, a nice wine, and he was like, "Oh, no, please don't." It just is so complicated that we don't want it. ANZ similarly. Matter of fact, I spoke at FMA last year. What they do is actually quite good, I think. They will give you a gift in kind and allow you to determine which what do you call it, nonprofit it goes to. You know, it could be to Kids for Cancer or something like that. But anyway, so it's not always easy to ascertain when a gift becomes something more than a gift and when it becomes a bribe. And certain cultures, for example, like this offer that was made to me a week or so ago, it was from one of our Chinese partners. You know, and you have to be very, very sensitive that in some cultures, gift giving is kind of the norm. Another example I did a couple of years, probably 2-3 years ago now, I went and did something for one of our clients. And as I was walking out the door, they gave me a little box. Oh, thank you, Jeff, for, you know, helping out here. I got to the airport and I looked at it. It's like, what the heck is this? And I peeled back the wrapping and it said Apple. And I was like, oh shit. It's like nothing Apple is cheap, right? And what they had given to me, I don't do Apple, by the way. So what they'd given me was the latest, greatest Apple, what do you call it, sport watch? And I was sitting there at the airport and I Googled, it's like, geez, Louise, that's like $600, for just going. And it was somebody who could have influenced and clouded my judgment, who I would have preferred to give business to them. So anyway, I passed it over. Ultimately, I gave it to a student after recording it in the journal. Okay, so these are different sources of pressure. Investment banking relationships are probably the most fraught, because you may or may not have an awareness, but in investment banking, there's a reason investment bankers make so much money. It is just such a lucrative piece of financial services. And there's a lot of money sloshing around, So, investment bankers are, in case you don't know, or who underwrite new IPOs or different offerings. So basically they commit to taking up all of an IPO or a portion of it. And they have different kind of commitments that they make. So they're out there pushing it as hard as they can to sell off, to realize the return and to sell off all their holdings. And there's a lot of pressure, which I think if you look historically, IPOs typically lose money initially, like within the first couple of months, certainly, because they're all hyped up, and that's part of that process. Travel funding, I've already spoken about that. Credit rating agency opinions. You guys, some of you are not maybe that old. Robert Frizzell, you would be old enough. I'm looking at you. So the whole global financial crisis, at the heart, those of you who aren't students of history, financial history, fundamentally, the whole financial crisis, global financial crisis of 2007, 2008, that it was all due to credit ratings, largely, where you have, Moody's, Standard & Poor's, they come in and, they're on the hook, and they're kind of looking the other way and giving an offering a higher rating than it deserves. And of course, if you have a higher rating, it's going to sell for less. It's going to have different return structure, etc. And that was the GFC in a large part, was due to that. And some very famous accountancy firms, etc., went out of business on the back of that. Not to mention investment houses. Okay, goodness gracious. Protect integrity of opinion. So this is procedures for compliance. I'll just focus on a couple of these. Limit gifts, have a gift-giving register like I've described. Have a compliance officer. Protect the integrity of opinions. That pertains to the investment banking side of things. So making sure that you maintain that independence, that integrity of opinions by having a firewall between those people who are selling the offering and those people who are offering the opinion. That's critical. Okay. Okay, we're still in section. We still have 6 standards to go. Are you guys okay being here till midnight tonight? Misrepresentations. That's pretty self-evident. Members of Canada must not knowingly make any misrepresentations. Misrepresentations can be as simple as, for example, well, an investment in ABC stock has returned 10% per year over the last 5 years. So therefore, give me your money, I'll put it in ABC stock, and you'll make 10% next year. That's a misrepresentation. Because what happened in the past isn't necessarily going to be what happens in the future. And you can see where advisors might be tempted to make that misrepresentation to get that business. So that is a clear violation. So you have to be very, very careful of how you would state that was, the share has made 10% over the last 5 years historically. And while past performance is no guarantee of future performance, it does provide an indicator. Something like that, right? Which is a fair comment. Misrepresentation on credentials. And this, believe it or not, this happens not all the time, that's an exaggeration. But it does happen periodically where, like a misrepresentation would be on my qualification. So I'm a CFA. I passed all 3 levels, boom, 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 one after the next. I didn't repeat any level. So a misrepresentation would be, I'm a CFA charter holder, and I have passed all 3 levels without fail. So therefore, the advice that I'm giving you by nature is of a higher standard than my counterpart who maybe has had to resit the exam a couple times. That's a misrepresentation. It does not say that at all, and that would be a violation. To have your credentials, I mean, you see it all the time without belaboring the point. It's not uncommon to have people, and what I started to say, I think, is periodically, probably once or twice a year, it will come to the attention of CFA Society New Zealand, at least once a year, that somebody is claiming to be a CFA, when in fact they're not. And that's, well, they're not covered by the CFA Code of Conduct Professional Standards, but that certainly gets the interest of the CFA Institute when they find out people are misrepresenting the qualification and claiming to have a CFA charter when they don't. Work completed for employers, that comes to the plagiarism point of view. Attribution is what it's called. So you shouldn't be claiming to have done the analysis if in fact you're just photocopying somebody else's work. Okay, and there's many reasons for that, not the least of which is the plagiarism is unethical, even though in some cultures it seems to be ethical or at least allowed. But your clients, for example, theoretically will have had confidence in you as a person and the advice you had given, and placed a big stake in that advice, your personal advice. And then if you just grab something off the internet as an investment appraisal report and put that off as your own, that would be misleading your client and misrepresenting the facts. Okay, so stick with factual presentations. Verify outside information. I'm sorry, I do tell a lot of stories. I was asked to come into one of the fairly significant investment funds here in New Zealand, probably about 5 years ago. And they wanted to hear my thoughts on their investment committee. So investment committee, for those of you who don't know, is they kind of screen different investment options and make a recommendation, to construct a particular portfolio based on their analysis, and they'll make that recommendation. In this case, they were making the recommendation to their clients. And I remember reading the information the night before. This is a company here in New Zealand that has billions, literally, of dollars under management. Billions, not millions, billions. And I was kind of prepared the night before, and I read, kind of the brief and what they were describing as their investment committee. It wasn't an investment committee at all. What it was they were downloading data from Morningstar. They were downloading data from Morningstar without doing their own due diligence and claiming it basically was their own, and putting that out there to their investors that this was the result of the investment committee, right? And they weren't doing it maliciously, to be fair. They just they didn't have a full appreciation what it meant, what the function of an investment committee was. You know, they were just taking Morningstar, taking it at face value. So this goes back to the verify outside information. They were not doing any due diligence. They were not validating the Morningstar analysis. And Morningstar is you know, they provide pretty good analysis, certainly a good starting point, but you wouldn't want to be misrepresenting it. Okay. Misconduct. Must not engage in any professional conduct. And the key thing with this is professional. So must not conduct in or engage in any professional conduct or any conduct that impugns, any conduct that impugns the industry, capital markets. You know, so, you know, the question would be, you know, for example, if you get caught with a, I don't know, what do they call it here in New Zealand? DUI, drunk under the influence. That's what I call it. Is that what they call it here? So if you've been drinking too much and you get pulled over and you get whacked in the booze bus, you know, for an infringement, is that considered misconduct? Catherine Aloso, what do you say? You don't know? Oh, sure, you don't know where the unmute button is.
Sorry, can you repeat the question again, Chief?
If you get pulled over in a booze bus, you've had one too many glasses of wine.
Yeah.
You get a ticket. You get hauled before the authorities. You lose your license. Is that a violation of standard 1D, misconduct?
I think so.
Does it impugn, does it involve professional conduct? No. No. So in this case, it doesn't. It doesn't impugn the, you know, the profession. You know, on the other hand, if you have, like happened here close by where I live, probably 10 years ago now, the principal, the headmaster for the local intermediate school got whacked for drunk driving. He lost his job. Why? Because that, you know, he in his profession as a headmaster puts himself up to his students as being, you know, representing this certain set of values. Okay, but in this particular case, it wouldn't be. It wouldn't be a good reflection, but just getting picked up for DUI is not a violation of 1D. Typically, the types of misconduct that would be a violation of this particular standard is anything to do with dishonesty. That's the big thing. Deceit, dishonesty, fraudulent behavior. All of those would definitely be a violation of this standard, okay? Because at the core of what we do as a profession, you know, we need to have that ethical underpinning, and we need to act in an honest fashion and not deceitful, et cetera, et cetera. Okay, but these other violations, anything to do with fiduciary responsibility would be a violation of this standard. Anything to do with deceit, dishonesty, violation of the standard. Other things that solely pertain to your personal values. If you got caught, you know, smoking marijuana, I don't think anything happens at this time and place, but something like that, not an issue. But any of these other things that I talked about would definitely be an issue. Okay. Okay. Okay, I'm scrolling through. I see a number of people I can pick on now. So conduct that damages the trustworthiness or competence, your competence would be an issue. Personal bankruptcy, not so much, unless it was something that was due to some of the other issues. If you declared personal bankruptcy because you were being fraudulent or deceitful or etc. But you know, there's many reasons for personal bankruptcy, even though it's related to, you know, financial management, I guess, ostensibly. But a lot of people in the States particularly go bankrupt because they can't pay their medical bills. Okay. Cool. Okay. So here we have question time. You guys read that? I think you can read that. I'll give you a second to read that so I can take a minute to refresh. This is pretty self-evident. So cook this down to the basic facts. Has this been an objective sort of valuation? Is the investment management firm giving sound advice? The firm's brokerage unit has issued a sell recommendation, but the investment banking department, they asked to have that changed to a buy, because the investment banking unit, they want to offload as many shares as possible. So there's obviously a disconnect here. Okay. So without even understanding fully the dynamics, you see that there's a discord. So the answer are, number one, increase the recommendation by no more than one increment. In this case, to a hold recommendation, so buy, sell, hold. Place the company on a restricted list, so place ETV on a restricted list and give factual information only about the company. Or C, assign a new analyst. Clearly it's B. And what this situation describes are the two kind of functional areas of the investment management firm. You've got the investment banking side, and then you've also got, you know, the brokerage side who are looking to sell, to buy or sell. So typically what's done in this situation is if you have both of those functions within your organization, you would construct a firewall where the investment banking side of things has no communication with the brokerage side of things. Okay, B is correct. Let's skip through that. Integrity of capital markets. Okay, so integrity of capital markets, this is probably the easier one. And this is just talking about probably the most prominent section here would be insider trading. And we can get into that. This is only two. Insider trading is using material non-public information or market manipulation, which also occurred in New Zealand. Matter of fact, one of my colleagues at Massey University, who's now retired some years ago, he was really good. He had a little bit of money. He came from money, and he was quite adroit. Could I say that, Vika? He was adroit at market manipulation. He knew how to do it. So he could pump and dump. That's what we call pump and dump. He could pump up the market, kind of throw a bunch of money in and kind of get people. And in fact, what he used to do that with specifically was telecom back in the day with telecom. And he would pump and dump with telecom. He would put a bunch of money in early in the day, and people go, oh, look at, there's all this money coming in. The volume is really jumping through the roof. And then he would wait and he would have preloaded his holdings, and he would wait and jump out of it later in the afternoon and make all kinds of money. Okay, so let's talk about these two things: material non-public information and market manipulation. Insider trading is 2A, material non-public information. And the challenge here is, if I can say, the challenge here is ascertaining what actually constitutes materiality, material non-public information. And what materiality implies is information that if you had access to that information, it would sway your decision-making process. It would sway your appraisal or valuation of an asset. Okay, if you have material non-public information, you are not allowed to trade on it. Okay. So, for example, most firms now, they go through a lockout period where, for example, if you have a company, this, I don't know why, I was on the phone earlier today with ANZ, so I've got ANZ on the mind. So let's say ANZ is coming out with their earnings report, and generally what they do is they have a blackout period. So for a week prior to their earnings announcement, their CEO and nobody in the organization is allowed to do interviews, because that could be construed as, kind of signaling the market on, maybe what their earnings may or may not be like. Okay. So material, non-public information. So it's anything that can affect the value of an asset or determine kind of your decision making. So I think I'm repeating this. So material label would have an impact on the price. What's actually interesting here is that there's a phenomena documented quite well in financial research. It's called post-earnings announcement drift. And I think, Vika, you've got your master's in finance now, you would know this, post-earnings announcement drift. And even though any news pertaining to earnings is blacked out, there seems to be a leak. And what you can see with what's documented in the research, empirical research, is you see, for example, if you have a positive earnings announcement, and like the 10 days before the earnings announcement, you'll see the value of a share go up, until it comes to the day that the earnings announcement is made. So what that implies is that there's insider information leaking out there, that people are trading on earnings prior to the earnings announcement. And then what happens is, after the earnings announcement, it typically flattens out and actually declines after a period of time. Okay? So some of the different areas: earnings, mergers, acquisitions, changes in management, significant change, like when Stephen Jobs initially stepped down, that would have been really huge. If you had knowledge of that, management change, that would have been huge. Innovation, new, Pfizer coming out with a COVID vaccine. Matter of fact, if you think about that, there was actually a lot of speculation that, for example, it's still kind of in the deep dark net, that Fauci, who is the prominent figure in the U.S. With the COVID response, was accused of trading on Pfizer stocks prior to them announced, early on in the stage, before they'd gone through the clinical trials. That's been disproved, but people in those kind of positions can have that sort of insider information on innovations with products, processes, and discoveries, new patents, which would have been the case of Pfizer, etc. Okay. Okay. So information becomes public once it is disseminated and disclosed broadly. So I think in this case here, dissemination is the key word, where you have to, as an organization, get that information out there, like through mass media, through social media, or through emails, or you release on your earnings announcement day, instead of releasing it to one or two of your key brokers, you release it in a general, like typically they would have, like a presentation of ANZ is making an earnings announcement. They would invite, all and sundry from the investment manager sector to come in and hear their earnings announcement. Okay, this is a key one here: mosaic theory. Mosaic theory basically says that it's perfectly okay if you're able to piece together readily and publicly available information, if you can piece it together and create a mosaic, it's like having a 1,000-piece puzzle. You know, you look at the box of all the puzzle pieces and it makes no sense. But after you spent the entire weekend putting all the pieces together, suddenly you got a picture, right? So this is a question that I guarantee you will have, mosaic theory. So mosaic theory says it's okay if you're able to, for example, I talked about when Stephen Jobs, you know, stepped down as CEO, or he would have been CEO of Apple. If you're able to look at publicly available information, for example, real estate records, oh, geez, what? He just bought an amazing new house in Jamaica. Oh, gee, what? You know, he's suddenly taken up an interest in, extensive interest in golf. Oh, gee, what? He's done this or that, that would indicate to you that he was ready to go into retirement. If these were sources of public information that you were able to piece together to determine that Steve Jobs was stepping down, that's perfectly okay. That's called mosaic theory. Okay, but it has to be available publicly. Okay, so mosaic theory. Not sure what's happened here. Okay, so again, firewalls is a word that you'll hear, which is the same as physical separation of departments. Personal trading limitations, I'll point that out because basically, or you might actually have people who potentially in your organization have access to non-public information. You would block their trades, like on the lead up to an announcement, you know, to just make sure that there's no perception of insider trading. So personal trading limitations, proprietary trading, special trading procedures, these are all different things. So just kind of keeping an eye on your staff and limiting their ability to trade on non-public information. Okay. Market manipulation, the last point, must not engage candidates, members not engage in practices that distort prices or artificially inflate trading volumes with the intent to mislead market participants. I've already alluded to one, the pump and dump. There's many examples of you know, and I've got to say, there is some dodgy dealings that take place in the market, and that's a fact. There's another one, which would be window dressing. So you might invest in a particular fund based on their style categorization. Say, for example, you might invest in, you as an investor might be interested in sort of low risk capital or low risk sort of shares. So A grade sort of investments, blue chip, I should say. And, you know, it's a very competitive market. So what funds have historically done is what's called style drift. So if they invested purely in blue chip stocks, they wouldn't beat their peers in terms of performance. So there typically are different reporting periods, like what you hold in your fund. So you know, towards the end of a quarter, you have to declare the shares that you hold and the percentage that you hold. So kind of a, you know, unscrupulous fund manager might go into more risky shares prior to the declaration date to bump up the returns, because as you would well know, risk and return, etc. So they would do that, but then on the declaration date, they would revert, they would sell off their risky assets, they would go back into their style mandate and invest in blue chip stocks. And then they come in and they can report over performance. Instead of making, you know, 7% return that all their peers has been making, they might show an 8% return. But that's because they've manipulated their performance reports by doing what I've just described. Okay. Transaction-based, another kind of common trick in the industry is you might be launching a new fund, and what you first need to do is you need to establish a lot of this. I think for you younger people in the room, a lot of this, and those of you who aren't in the industry already, kind of goes over your head. But you have financial assets are basically like buying and selling apples and potatoes from Pack and Save. So you have to establish a market. So if you're putting together a new fund, the first thing you need to do is you need to establish volume. So you need to establish that you have a market for your particular fund. So how do you do that? You've just introduced a new fund. So what you do is you can contact your friend, like Ed's up here on my screen. You can contact Ed's who's got another fund. You can say, hey, Ed's, can you buy 1 million shares of my fund? And I'll guarantee I'll buy it back from you tomorrow. Okay, and can you do that again next week and the week after that and the week after that and the week after that? Because what you've done is you've manipulated the volume on that particular fund to suggest to any potential investor that it's a liquid investment. When in fact it's not, because I've been speaking to Ed's and it's just kind of going back and forth from his account to my account. That happens. It happens all the time. Dodgy business. Hilke, what do you think about that? Does that sound dodgy to you?
Sorry. Which business is dodgy?
Dodgy, jacking up the liquidity of a fund that you've just launched artificially by having your friend buy up all the shares and then agreeing to buy it back from him.
Yeah, that definitely does not sound like a legit way to do it.
No, that's called market manipulation. Okay, so that's something you can't do. Okay, but it takes place, and like I said, here in New Zealand was pretty much considered a cowboy market up until 2006, a cowboy market. Because out of the developed financial markets, this was kind of the last bastion of kind of the wild, wild west cowboy markets. There's a lot of things you could, up to 2006, you could have got away with, which now you can't. Okay, Mosaic theory holds that an analyst, A, violates the codes and standards if the analyst fails to have knowledge of and comply with applicable laws. That sounds more like standard 1 to me. Is that true? B, can use material, key point, material public information and non-material, non-public information in the analyst's analysis. That's B. Should use all available and relevant information in support of an investment recommendation. So what really gets my curiosity here with the answer C is when it says use all available information, which we've just learned that there's 2 types of information. There's publicly available information and there's non-publicly available information. So I think, can we agree, Daniel Teo, that we can rule out C? I think we can rule out C. Yep. We agree with that, Daniel? You au fait? Are you au fait with that?
Yeah, I agree that we use all the available information in the market.
So B is correct, and I see a big thumbs up from Vika. So Vika clearly agrees with B, can use material public information and non-material non-public information. Okay, so that's it. Procedures for compliance, prohibit transactions that deceive market participants, tick. Dissemination of false and misleading information, tick. Transaction-based manipulations, that's what I described earlier, which are transactions which can pump up, artificially affect the price or volume to give them, this is exactly what I spoke about, give the impression of activity or price movement in a financial instruments, which represents a diversion from its normal state. That's true. Yeah. Oh, the last one actually is a good one. Securing and controlling a dominant position in a financial instrument to exploit and manipulate the price. And that's the example I gave you of my colleague, now retired, so I can take his name in vain without actually mentioning his name. Because New Zealand capital markets, share market is so illiquid. That's the one thing about if you get, what I mean by liquid is, like I said, this gentleman manipulated telecom. There's no way you could do that in a market like the United States. Because to move the price of that, of a telecom equivalent in the United States, you'd have to have billions of dollars, like legit billions of dollars, because the market's that deep. But here in beautiful New Zealand, country of 5.1 million people, 6 million if you count all the people stuck overseas, you know, it's easy to have with a few $1 million, you can actually manipulate the market.